Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Gabriel Yap. He's the Executive Chairman of GCP Global. Gabriel, good to have you on the show.
Always good to have you, Brian.
Now, Gabriel, let's take a look at how markets are performing before getting your insights on this week and the markets. Now, the SGX is at 2,906.62. It's up marginally at 0.04%. The Bursa Malaysia is at 1,581.23. It's marginally down at 0.23%. But across the region, it's a sea of green. The Nikkei is up 1.34% at 28,720.62. Shanghai Composite is up 0.46% at 3,518.09. The Hang Seng is up 0.52% at 29,265.65. The ASX 200 is up 1.11% at 6,840. And the Kospi rounds it off at up 0.24% at 3,094.94. What's your view on the markets across the region? It's mostly green.
It's fantastic, Brian. I think since the last program that we had with you, you noticed that the stocks and the sectors that we have actually picked up on your program has progressed very well this week. And in fact, in the last program, we mentioned about the listing of Kuaishou, which actually listed in Hong Kong today, and it's up 300%, the best IPO, on a first day performance for a long while across the world.
But Gabriel, what is the reason for that? It was oversubscribed by more than 1,200 times. What was the interest in the stock? I mean, it's, after all, the second most popular short video service after ByteDance's Douyin. So what's the hype around this?
First and foremost, Brian, is actually not a hype. The fact is that Douyin, that's part of the ByteDance in China, has done very well. Its MAU is 100, whereas for Kuaishou, it's half of that. It's coming to 300 million. The things that both companies are actually on a race to actually dominate this short video segment of the market. But the key thing is that, dominating this particular segment of the market is actually taking a lot of screen time as well as essentially market share away from the traditional YouTube kind of platform. So the equivalent of YouTube in China is actually like Baidu, for example, search, Google, that's Baidu, as well as actually iQIYI. So in this case, they taking market share from them actually enables a few things. One is actually the companies like Kuaishou and Douyin, it's possible to grow other verticals, meaning that other than doing short video where they monopolize and get the MAUs and the DAUs increasing every other month, there's a possibility they may be able to operate e-commerce platform and e-payment platform. For example, that's what ByteDance, the owner of Douyin, is trying to do right now. They already have formed an e-payment system. So the verticals as well as the tentacles that can spread from dominating this short video market, the ramifications in the future are huge, Brian.
So that is so essentially then you're buying potential as well as current earnings.
You're not buying current earnings because both companies are suffering losses. In fact, the losses for Kuaishou, according to its IPO Perspective, is actually widening. But then again, as listeners of your program, as well as people who have attended GCP Global classes, we have told them, that companies like, for example, last year, Pinduoduo, SEA, as well as actually Tuan, those companies are still bleeding and losing money. But when they are actually losing money, it's because they are reinvesting the free cash flows back into your original business, growing them, getting greater market share. In terms of revenue growth is very strong. In terms of cash flows is very strong. It's a matter of time before they break even. But as they actually gotten greater market share, the conventional thinking about investment right now is that, these are companies to bet on, not your traditional property companies or banks now. That's the ones to be making money. And that's what we have been telling our students in our GCP Global investment classes.
Now, Gabriel, This successful mega IPO is really part of a broader story, isn't it? Of successful an IPO boom in the Hong Kong Stock Exchange in the last couple of months. What's been fueling this flame of this rising IPOs in Hong Kong?
Right. I think essentially the differences in the fortunes between the Hong Kong stock market as well as compared to say Bursa Malaysia or Singapore is really, really very startling and very apparent. One is the fact that if you look at Hong Kong, essentially the Hong Kong market is basically fueled by few things. One is that the exchange is not sitting around, they are actually establishing cross-channel instance through the North-South as well as actually the South Hong Kong Connect, where mainland investors can actually not only just buy A shares, they can buy H shares traded in Hong Kong. Secondly, they have also established the Shanghai Star Market. As the name suggests, the Star Market actually is the market to go to for all your technology companies. And three, this markets like the Star Market, the China Connect, as well as Hong Kong market is the hotbed for tech companies, which is severely lacking, for example, in the likes of SGX or Bursa Malaysia. And you can see that the orientation for technology, as what we teach our students in our classes, that it is a new asset class to be in, and it is an asset class that you have to be in to be making great money.
Now, moving closer to home, investors have been looking at REITs as a safe option that gives steady returns and capital appreciation, an area which you basically are a guru. But not all REITs are equal. What are the types of REITs that we perhaps should be avoiding this year?
Right. Very good question, Brian. But your viewers, if they have actually read my published book, which is now available in the Malaysian bookstores, come Chinese New Year, which is actually next week, you'll notice that some of the traits that I share about REITs to avoid, whether we have done a severe study into those REITs that have underperformed for the last 3, 5, and 7 years. So in my book, Making Millions in REITs, I have actually highlighted that a few traits. One is the fact that's very many of those REITs that don't perform are actually flirting near the gearing level. So these are the ones to avoid. Two, the ones that don't actually perform well are those where you can discernibly see the sponsors, do not seem to have the alignment of interest with the minority shareholders. So in terms of basically asset acquisitions, as well as actually in terms of dishing out rights issue, they're normally not very favorable terms, or they are still undertaking, for example, acquisitions which basically dilute the company substantially. So for example, I've questioned, in my book that companies like, for example, Lippo Malls, when they acquire Lippo Puri Mall for $369 million, that's US. When their market cap is less than 250 million Singapore dollars, that's in Singapore dollars.
Wow.
How is it beneficial to shareholders?
Yes.
Because in the end, to do the financing, you have to issue, for every one share, you have to issue 1.6 shares, priced at a severe discount. So, when you have a discounted rights to finance, an acquisition that may or may not be beneficial, to shareholders. Of course, if you speak to the REIT, they will tell you it's beneficial, But if you look at the track record of the manager as well as the REIT, it's sometimes a different story to be sung.
Thank you very much for your insights, and thanks for coming on the show, Gabriel. Now, we've been
Thanks,
speaking
Brian,
to Gabriel.
Happy Chinese New Year.
Yeah, and we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on the ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.